which ratio is most useful to you if you are a shareholder? Should you look at GP ratio? Should you look at NP ratio? Should you look at return on equity? What is the ratio? What does that mean? Welcome. This is Amit Popat welcoming you one more time to the Investing Master Series. And in this particular video, we will dive into the profitability ratios. As you know, in the last video, we mastered accountancy in just 11 minutes. If you have not gone through the last video, and in fact, all the past video of the series, then do watch that and then come to this video. It will make much more sense. So without wasting further time, let's dive into the profitability ratios, and we will continue taking the same example that we've taken in the last video. So that's why I am saying this time and again that if you've not seen my previous videos, do go through that. This investing mastery series, probably we are on day number 17. Previous 16 videos have been absolute gold, right? And one more request, jab main request kare raha hu, do subscribe to our channel and hit the like button to every video if you like it. If you like it, let's move forward. Thank you. So income statement is the very same income statement that we've taken in the last session when we were learning accountancy in 11 minutes. So sales is 1.5 lakh, purchase is 90,000, closing stock 25, so COG is 65. I'm left with a GP of 85,000, and then from GP of 85, I subtracted salaries, rent, depreciation, so I got EBIT, less interest, I got EBT, less taxes, I got PAT. Okay, so these are the income statement with which we're going to continue. Now let's move further. So the first ratio that we're calculating is the GP ratio. What is the meaning of GP ratio? What is the formula of GP ratio? Let's dive into it, and at the end of each video, we will try to understand what each does mean. So GP ratio, the simple formula is gross profit divided by sales multiplied by 100 if you want that in terms of percentage, so you can do that as well. In our example, our gross profit is 85,000 as we have calculated in the income statement. And one request that I would like to make when you are doing all this is, if possible, the income statement that we prepared, just go back in this video or you just go back in the previous video and write down every figure of P&L balance sheet, because this video and this video onwards, and I'm sure if you're a serious learner, if you're a committed learner, if you're a committed investor, then you would be making diary of every video that I'm doing for you. So one request is, in last video we had the P&L balance sheet. Keep every number handy so that whenever I talk, whenever I say a number, you should be able to have the comfort. So 85,000 is my GP, 1.5 lakh is my sales, multiplied by 100 if I want that in terms of percentage. That gives me 56.67% of GP. And higher GP ratio indicates the better profitability. Of course, if company has got a 56.67% GP, that means company is able to generate 56% profit from its sales on a gross basis. On a gross basis means sales only minus the cost of goods sold. There are many more expenses which are yet to be subtracted, like, as you know, in this particular example, salaries, office rent, depreciation, electricity bills, so on and so forth. Now, higher GP ratio can arise because of two reasons. See, you need to understand this. When I'm in this particular video, definitely you're understanding the formula, you're learning that it is very important and you should learn that. But more than that, according to me, if something is more important that you should learn is the interpretation of each and every ratio. Okay, so how can a company achieve higher GP ratio? Company can achieve higher GP ratio because of two reasons. Number one is because of company's efficiency. Like, it has been able to keep its cost of goods sold at a minimum level, and that's why it is generating the higher profit. Now, how can a company keep COGS high or lower? Number one, buying at a good prices. Number two, keeping the inventory storage cost low, because whenever you have the inventory, there is a storage cost. How can you keep inventory storage cost low? By following a technique like JIT, just in time. If company has got an effective value chain, supply chain, the time taken from purchasing the material to bringing it to the machine on the factory, if company can reduce it, these are many. See, understand, business is all about optimization. the deeper level of optimization you do, the better it will be for your business. Right? Every point, like, and let me tell you over here, a small optimization can create a big impact on your business. Like, I don't know whether you are aware about this or not, but if you follow just-in-time system, just-in-time is a system, is a scientific approach where raw materials arrive in your factory just at the moment it is needed. So the objective of JIT system is to take your inventory storage cost to as good as nil. Minor optimizations can create huge impact at a company level, and especially when you're doing the business at scale. Okay, like companies like Hindustan Lever and all that, they run the turnovers into thousands of crores. A small optimization will make impact of few hundred crores, and that's where actually the business profit comes. So one reason is it could be because of company's efficiency, or second can be the premiumization. Like if company has been able to sell its product at a higher sales price, definitely it will have a higher GP. Like let's say companies like Apple, they are able to sell the product at a premium prices because of the brand that they have created. So, but naturally, Apple will have a higher GP ratio. Same way you say, for example, Colgate. The cost of raw material and everything is going to remain same, like for X company and for Colgate. But because Colgate is a brand, Colgate has got the brand value, it may be able to sell their products at a higher selling price and as a result increasing the higher GP. Like, if you go through all this, like this luxury watch brand, Seiko, which I'm wearing, again, it's a brand. So I don't think, when I bought this watch, it costed me 51,000 rupees. I'm sure the raw material that would have gone into it would be less than 5,000 rupees. Of course, there are margins of wholesalers, retailers, transportation cost, and everything. I understand that. But because Seiko is a brand, it can sell the product at a premium rate. Like Tommy. If you buy a Tommy shirt, it costs you 5 to 6,000 rupees. Whereas a non-branded shirt, of course, Tommy has got a quality. I'm not saying that it is not of quality. But this huge impact is something the premiumization, and that's why company can charge the higher profit. But now, having understood higher GP ratio, you also got to ensure that company is operating efficiency as far as its operating costs are concerned. Like if it has got you know too much workforce and too much money is going into salary, too much money is going into electricity, too much going money is going into administration, too much money is going into selling and distribution, then again, despite having higher GP ratio, company will not be profitable at the end of the accounting period. And for that, we calculate operating profit ratio. Here the heading is incorrect. Just forgive me for that. So that's why operating profit ratio comes into picture. It typically looks into the profit of business, not just gross margin. Like if a company has got a good gross margin, but it is spending too much on admin and selling and all that, in branding and all that, it might not be having the profit that it desires at the end of the day. So operating profit divided by sales, in our case, it is 45,000 divided by 1.5 lakh, 30% operating profit margin we have. And again, operating profit ratio could be because of company's efficiency. Like if you can use your employees optimally, I'm not saying exploit them, but if you've got a proper systems in place, proper softwares in place, and a company who is doing all the things manually needs 3 employees, whereas because of you have done the optimization in your processes, in your machinery, if the same work can be done by 1 employee, definitely your operating profit is going to be higher. It does make a sense, right? Same way, for example, electricity bill. If you have installed a solar system, of course there would have been an investment in fixed asset, but if you can reduce your electricity bill, your operating profit will be higher. So one reason operating profit could be higher is because of company's efficiency, and second is operating leverage. Operating leverage means if certain costs are fixed, like employee salary is fixed, but if with the same salary, if you can generate a higher turnover, your operating profit ratio will be higher. So that is typically what we call as an operating leverage. Impact of fixed cost. The fixed cost remains fixed, but keeping that fixed cost fixed if you can increase your turnover, if you can leverage that, then you can get a really big boost in your profitability. So here it has gone reverse. ऑपरेटिंग प्रॉफिट की स्लाइड में मैंने गलती से नेट प्रॉफिट लिख दिया और नेट प्रॉफिट की स्लाइड में गलती से ऑपरेटिंग प्रॉफिट लिख दिया. आई होप यू अंडरस्टैंड दैट and I hope you're okay with that. Considering the content that you're getting, I hope you'll be okay with that. So net profit is net profit divided by sales into 100. The reason for getting into the net profit ratio is even after operating profit, if company is paying too much in the form of interest, if the company is not tax efficient, big amount is going in the form of tax, then net profit ratio will go down. In our example, it is 30,000 divided by 1.5 lakh. 20,000, I guess it is a good ratio. And again, higher NP ratio can be because of company's efficiency and but mainly financial leverage. What do I mean by financial leverage? See, if you borrowed some capital debt, the rate of interest will be same, the amount of interest will be same. But if keeping the amount of interest same, constant, fixed, if you can generate higher turnover, then but naturally you will be making higher profits. Now this is a clue for you guys. In our example that we are continuing, we've got a good GP margin of around 56%. We've got a good operating profit margin of around 30%. We've got a good NP margin of around more than 20%. Still, this investor, this gentleman, looks tired, looks tensed. Like, what is happening with this company? Any guesses why? We've got a good GP ratio, we've got a good NP ratio, we've got a good operating profit ratio. It is just an example so that I can drive home the next concept. This gentleman is worrisome. Anybody, any guesses why? Put in the chat box. See, you need to understand this. As an investor, profit on sales, good. Operating profit on sales, good. Net profit on sales, good. But what really matters for me, what really matters to me is how much profit company is generated using the capital. I'll give you an example. If our company has got 1.5 lakhs of sales, 85,000 of GP, 45,000 of EBIT, 30,000 of net profit on a sales of 1.5 lakh, everything good, so far so good, awesome, beautiful, wonderful. But to generate a sales of 1.5 lakh, let's say for example, if company had put an assets of 10 crore, then what? 10 crores of asset has been put in the business to generate a sales of only 1.5 lakhs. Understand, my dear, as an investor, you will never make money from this company, though you might feel like, my God, company is doing good profit on sales. But my dear, as an investor, for you, what really matters is the profit that company gets on its capital, on its assets. And that's where actually you will make money. If this was a bulb on moment for you, just type in BO. And I am sure it was a bulb on for you. Type in bulb on in the chat box, please. That, okay, return on sales is good, profit on sales is good. But as an investor, I'm going to look at what is my return on my capital. Right? What is my return on my capital? That is something I'm going to look at. So, let's continue further. The next ratio that I calculated is the return on capital employed. It is operating profit divided by, okay, sorry. It is operating profit divided by capital employed. And if you want that in terms of percentage, you can, of course, multiply it with 100 and you will get that. So, in our company, operating profit is 45,000. Average capital employed. Here, average should be taken, but in our company, as it's a new company, we will not take average. In case of an old company, you should take average. So 45,000 divided by 2 lakh into 100, that will give me 22.5%. And ROC shows company's efficiency to utilize its capital and generate the best. How company is utilizing its assets, capital? Is it able to generate a good sales? Is it able to, generate a good profit on that? Of course, higher ROC does not mean company is best. Like, for example, if there is a service industry, like for me, we are into coaching business, we are into brokerage business. So we are not a capital intensive company where, huge machineries and huge office are needed. I can do this from my home just having three things: one laptop, one camera, and one mic. This is fact. So, my dear, That's where things become very tricky, and that's where people fail to understand this. If you just rectify this bookish knowledge that higher ROC is better and I'll invest in that company, then you will always end up investing into service industries and you will never invest into manufacturing industries, because manufacturing companies are highly capital intensive, right? So you need to understand this, which kind of company you are looking at. Now here, return on capital employed, definitely it's a good ratio, but problem over here is if company is a highly levered company, like huge capital has been uh, taken in the form of debt where the interest rates are too high, it is possible that at the end shareholders will not be getting anything. So for that, the last ratio that we calculate is a return on shareholders equity. It is PAT upon average equity, profit after tax, because that is something that is left for shareholders. If companies got a good return on capital employed, good profit, but most of the things are going in form of debt, interest, like that happened with Anil Ambani group of companies. At some point of time, Reliance Communication was making good profit, but the company was highly levered. And the moment business went down a bit, entire company got wiped off. Okay. So 30,000 divided by 1 lakh 30, we had got a 1 lakh of owner's equity at the beginning, 30,000 profit got added, and this ratio is 23.07%. So return on equity indicates the return available to the shareholders, and ideally return on equity should be able to beat index return. Because if your company is not able to beat index returns, why should I invest in that company? I should simply buy the liquid Bs or Nifty Bs or ETF or something and I should be relaxed. Why should do why should I take all the pain of analyzing company and blah 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 blah? I will not do that. Okay. So ideally any company's ROE should be able to beat the index return, then only that company is worth investing. So this was all about profitability ratios. I hope you got a lot of learnings and I want you to write 3 key learnings from this particular video in the chat box, comment box, and I'm personally looking at your comments. See you in the next video. Thank you.